When you look at a stock ticker, you see a single, stable number. But look just beneath the glass of that screen, and you will find a chaotic, high-speed collision of data points. We tend to perceive stock prices as absolute, static values. In reality, investors are participating in a system where no central authority exists to stamp a definitive price tag onto a company's shares. Textbooks often describe a stock trading at its discounted cash flow value, a measure of future earnings. In the high-frequency reality of the exchange, that is a comfortable fiction. This diagram illustrates what actually sets a stock price. We call this architecture the liquidity stack. A price is an emergent property of this tiered, mechanical system. To understand how this works, we will build this stack from first principles. We will start with the micromechanics of the exchange, layer in the sudden shocks of corporate signals, and finish with the massive macroeconomic overrides dictated by central banks. Grasping modern finance requires letting go of the illusion of intrinsic value. You have to master the physical mechanics of market coordination. Layer 1 begins in the secondary market. On the London Stock Exchange, shares trade strictly between investors, transferring ownership without providing new capital. This digital interface is the order book, the live scoreboard of the market's ongoing auction. Buyers post bids in green on the left, sellers post asks in red on the right. The gap between them is the spread. Operating behind this book is the exchange's matching engine. It is a completely blind, automated coordination system that constantly scans these incoming orders for a point of agreement. The engine follows strict rules. The first is price priority. The highest bid and the lowest ask always win the execution. When those two prices finally overlap, a trade occurs. The second rule is time priority. If multiple buyers offer the exact same price, the order that arrived milliseconds earlier gets executed first. The rest wait in line. But this pure auction system has a fatal vulnerability. If buyers and sellers aren't continuously present, the order book empties out, liquidity dries up, and trading grinds to a halt. This brings us to Layer 2, market makers. These are institutional players who act as the necessary plumbing for the exchange, stepping in when natural counterparties are absent. Market makers have a specific economic incentive. They continuously quote both bids and asks, agreeing to trade with anyone. Their profit is the spread, the tiny difference between their buying and selling price. By taking on this inventory risk, market makers guarantee that when you click buy on your brokerage app, you experience immediate execution, without having to wait for a natural seller to arrive. This mechanical plumbing dictates the absolute baseline of a stock's price. Every quote is simply the last point where an automated algorithm successfully paired a disagreement. Now we move to Layer 4, information. To see how news alters the order book, we can look at data from the Indonesia Stock Exchange. A 2017 study by researcher Nera Marinda Mokhtar analyzed manufacturing firms listed on this exchange to isolate the exact market effects of a single corporate event, CEO turnover. A change in leadership acts as an event shock. It forces investors to immediately revise their long-term expectations regarding the company's strategic direction. As that news hits the lyre, a microstructural reaction takes place. Algorithms and market makers instantly cancel and replace their limit orders, and spreads widen to protect against the new uncertainty. The ledger is aggressively rewritten. This chart maps the study's first major finding. The data shows a statistically significant positive arrow connecting CEO turnover directly to abnormal stock market returns. The price spikes. But this introduces a structural tension.
Does the newly appointed CEO actually improve the company's fundamental performance fast enough to justify this immediate surge in the stock price? The mediation test reveals that the abnormal stock return is not mediated by actual company performance. The connection snaps. The stock moves before the company actually improves. Academics call this upper echelons theory. The market interprets a new executive team as a proxy for strategic revitalization, baking future hopes into today's price. It operates on signaling theory. The announcement itself is a signal that triggers automated trading algorithms and human sentiment before new products are sold or quarterly earnings are posted. Information moves the order book first, while economic reality catches up later. The market mechanically reprices the stock based entirely on the signal of change, completely independent of the firm's current fundamental output. If information is a shockwave, macroeconomics is a tidal wave. We have to pull back from the micro level of a single stock to the ultimate top-down force in global finance, the central bank. During extreme recessions, central banks can face a liquidity trap. This is a scenario where standard monetary policy fails because interest rates have already been cut to zero, leaving them with no conventional tools to stimulate growth. To bypass this trap, they deploy an unconventional tool known as quantitative easing. The central bank prints new reserves to purchase massive, predetermined quantities of financial assets directly from the open market. This diagram illustrates the specific mechanism of action called the portfolio rebalancing channel. The central bank's balance sheet expands to absorb vast blocks of safe, sovereign bonds. By intentionally removing these highly secure assets from circulation, the central bank engineers an artificial shortage of low-risk yield. Institutional investors, like pension funds and commercial banks, are now deprived of safe government bonds. To meet their return targets, they are forced to rebalance their portfolios, moving their capital down the risk curve and pouring it into equities. This brings us back to our micromechanics. That displaced institutional capital translates into a massive, artificial flood of bids hitting the buy side of order books across the entire exchange. This relentless, system-wide buying pressure mechanically consumes asks and drives up asset prices globally. It happens regardless of any individual company's earnings or corporate signals. This intervention systemically distorts market neutrality. It aggressively inflates wealth inequality by driving up the portfolio values of those who already own assets. Quantitative easing acts as the ultimate systemic override. It is a manufactured tide of liquidity that alters the gravitational pull of every single matching engine on the exchange. This animated model shows the completed liquidity stack. We can now see how the three scales of finance, market microstructure, corporate governance, and macroeconomics, operate as a single, unified machine. The market price fluctuates as an emergent property of infrastructure and flow, detached from the static figures on a balance sheet. This price represents the momentary output of an electronic matching engine, reacting to the informational shockwaves of corporate events, while floating on a manufactured tide of central bank liquidity. For aspiring financial analysts, running a traditional discounted cash flow model is a necessary but severely incomplete starting point. Relying solely on intrinsic value assumes a perfectly rational market. Such a perspective leaves you entirely exposed to sudden systemic shocks and the mechanical realities of order flow. To accurately read modern financial markets, you must dissect the physical mechanics of the exchange and the monetary balance sheet of the central bank with the exact same rigor you apply to a corporate earnings report.